Good afternoon, and thank you for joining us. My name's Andrew Freedman. I'm an analyst on the healthcare team here at Hedgeye. I'm joined today with Tobin, Managing Director and Healthcare Sector Head. Today we're going to hit on some of our top ideas as earnings season ramps up. And if you have any questions, please submit them on the QA box on the Hedgeye website. We also have a slide deck prepared, at which you can access via the link above the video box on the website. That being said, Tom?
All right, thanks a lot, Andrew. And thanks everybody for tuning in. I did send out a blast really quickly to the institutional subscribers a little last minute. So if you're on, thanks for tuning in last minute, but we'll also put up a replay shortly, which you can take a look at. The first slide is the healthcare position monitor. Part of the reason we're on today is to sort of touch on relative to our themes call of last week, put into context the J&J and UNH quarter, which I think spoke to a little bit about what we're looking for the second half and into 17 for the U.S. medical economy and how we're positioned more short than long. And on the long side, having some story stocks and product stocks with ATHNI and Illumina. But getting into the ACATAPER and some of the issues we talked about last week, where we look at the themes that we've identified and gotten pretty close to is on thinking that we're late cycle. We showed a bunch of evidence about that last week, that the demographic fallacy of growth is fairly well researched on our end. We think aging is a very, very small part and even exacerbates some of the issues facing healthcare as it feeds back into regulatory pressure to cut costs and the ACATAPER and deflation overall. The key chart, which I'd like you to keep in mind and keep on your desks going forward through earnings season and into its third quarter and fourth quarter guidance periods is this growth rate in the number of U.S. Medical consumers who are insured. And what we've done here is created an index compiling exchanges, Medicaid, Medicare, and commercially insured, deriving the commercially insured off of Kaiser Foundation data as well as non-farm payrolls and private payrolls. But we think, based on some very reasonable and conservative estimates, that we're heading into a sort of back to normal phase after an extraordinarily large gains over the last 2 years under the Affordable Care Act, which has added a tremendous number of medical consumers who, as we heard from UNH over the last several quarters, are consuming at an extremely high rate. The utilization finds a home too with employment trends. So when healthcare companies are busy, providers are busy, they're hiring. Again, you can see that bolus of new consumption flowing through in 14 and 15, slowing a little bit into early 16 here. And then you can see on the margin, again, where J&J talked about utilization, hospital growth continues to be below trend, where it peaked out last year, is doing okay for 2Q. So I think the 2Q earnings are probably in line to okay. And as you're tuning in to the Republican convention, if you're bothering, I watched a little bit of it last night with my daughter and had to make a lot of explanation about what was going on in terms of what people were saying, which was a little interesting. But what we can see in the forecasted federal government outlays, we've definitely hooked up. This is going to put incremental pressure, excluding Medicaid. You can see this massive hockey stick in over a long period of time. It was very stable, but now healthcare cost trend clearly hooking up. The question is what happens to that going forward and what's the response on the budget makers and policy makers. Absolute sales and EPS have also been hooking up after a long period of stable growth, even looking at the recessionary periods. Again, is this sustainable? We don't think so. We think this has largely been driven by the massive expansion in enrollment for medically insured consumers. Again, we can see this in the real PCE data for proprietary hospitals. Again, hooking up multiple standard deviations above the mean, hooking up again on the right-hand side after a very long period of just general stability and steady growth. Again, a huge phase transition that you can see there in the short term, but again, the key point is if that consumer trend for medical consumers that are insured, who consume essentially multiples of what their uninsured counterparts do, what's going to happen going forward? I think as that population slows, we're going to mean revert across both of those lines. The M&A stuff that we've been hearing about, including this morning, with some talk about the HMO mergers getting blocked by the FTC. This M&A cycle is past peak, or at least entering the final stages. Where growth gets dear in the early part of that, you're going to try to buy your way to growth, net of what you're seeing in your underlying business, take advantage of a strong tape. But I think that looks like it's clearly rolling over. Now, getting on to the J&J and UNH, these are just the two takeaways. This is one slide. Is my two takeaways from the earnings calls this morning. One, J&J got asked about utilization. They've been routine in commenting on utilization in the current period, and they basically said, listen, we think hospital volume is up about 3% and procedure volume is up at around 3.5%, but the front end on the physician office visits is down year over year, and that could down a couple percent, and they see this increase co-pays and deductibles. And that's a key point of our slide that we presented last week, is that healthcare remains an expensive and growing expense in the household P&L as this cost shifting continues towards the consumer, where the employer has really soaked up about 4.5% CAGR over the last few years, and it's up 81% for the consumer individually as this co-insurance, co-deductibles, et cetera, gets pushed to the household expenses. Now with UNH, their commentary was a little different, clearly having a bad experience with the Affordable Care Act and exchanges. And what we did here in the chart is looked at their medical claims payable, adjusting for what they called out over $1 billion of losses or incremental reserves that they made relative to the exchange enrollment of 750 to 650,000 lives, which is a massive, massive mistake on their part. But if we adjust that medical claims payable for this increase in reserve, and then divide it by the number of risk members in their book, commercial, Medicaid, Medicare, and the other risk-based business international, you can see that trend is slowing. So it would appear that their net of this exchange problem that they're having is that their reserve development, or the amount of medical claims payable that's on their books, is slowing on a per member basis, at a reasonable pace, and doesn't look like it's picking up. The U.S. knee market relative to J&J, they put up a decent number in hips and knees, but again on a 2-year basis looks like it's slowing. We'll see. I think a important call out was that their pricing now worse than 2%, sort of in that mid-2s negative. There's a fairly easy comp on pricing for 2Q for Zimmer, so I think that'll be an interesting data point to get when they report numbers upcoming. On AMN Healthcare, I've been doing a lot of work. As the JOLTS data has slowed, which is a key part of our model, we have very good tracking data, at least up until the point where we get this third quarter print, second quarter print and third quarter guide, and it's really the guide that matters here. But JOLTS clearly slowing, running at a very slow rate on a rate of change and as a year-over-year basis. These healthcare employment gains in context over a long period of time tend to come in a compressed period of time, late cycle. But again, the last data point there on your chart on the right-hand side is that just starting to downtick a little bit. Again, one of the bigger increases we've seen over many cycles happening coincident with the Affordable Care Act. Healthcare JOLTS openings are up multiple standard deviations and all-time highs reached last fall. And then the ratio to healthcare employment, if you want to normalize it, again, still looking like it's very high. When I run this through a organic growth model, again, comparing these data sets a couple different ways to what AHS talks about in terms of their organic growth rate, we get a really tight fit. And again, if we roll this forward, the slowing action, even in a very, very modest and conservative way, we get a pretty steep drop-off in their organic growth rate heading into the back half and into 17. The key problem here is that when we look at our tracker data, which again I think has very good visibility, but we have to prove this out over this coming quarter in the guide, is that we think there's going to be about 7,300 FTEs in the quarter and lower still for third quarter. 7,300 gets them to the guidance of 450 to 456 for the quarter in revenues when we take into account other workforce solutions, locum tenens. So it fits the 7,300. I think that's going to be a disappointment, and getting to a lower still number basically just puts us back to where we were in 14 basically. So that would be a massive down number in FTE count. I think pricing does not hold up in that scenario. And if we look at where AHS is a historical multiple basis, again, recovering to a near all-time high on EV to sales, which we think is the right number on next 12-month sales, but also on EV to EBITDA basis, looking like it's recovered somewhat. So the short interest then becomes very important. So how confident are we that we're going to hit this number given the short interest? It looks like people have followed us along or thinking the way we are about this name. That's either a cause for concern if they beat, obviously. We don't think they're going to. In fact, as I'm stressing out my 2Q model and third quarter guidance, I'm getting a decent comfort level with an inline to lower number for 2Q and definitely a lower number for Q3 on the guide relative to where consensus is. So I don't necessarily feel nervous, but in terms of confidence level relative to the short interest, you have to be extra sure. On MEDNAX, the maternity tracker continues to come in negative. We put up a note on this a couple weeks ago. I still have to update this last week, but relative to the quarter, again, maternity in the US continues to slow, sort of down single digits. Again, this is a largely commercially insured patient cohort that we look at in the tracker data, and then we roll that up to a doc-weighted type index using JOLTS in the maternity tracker, again, looking for continued slowdown in their adjusted same-store volume number. The announced deal activity for MEDNAX continues to be pretty slow. Odds and ends rolling in, particularly net of the VRAD, which is that big bolus on the left-hand chart. I think VRAD, anesthesiology in particular, are the two names that are really levered to this ACATAPER story, and then maternity tracker stands by itself. And the way this all flows into what we think about MEDNAX, particularly in the mid-70s, which I think is a very attractive short entry price, is basically what has to happen with guidance and where consensus numbers hit. Deal flow is slow. We'll see what they can do with radiology practices, which have just started their roll-up phase, and whether or not they can buy this lower quality brick and mortar to layer on top of the VRAD acquisition. We don't think that's really a great strategic fit for a lot of the docs. But if we look at what acquisition pace has to do, it has to double from here to hit numbers. So that's really the issue, because these deal multiples are higher. There's a lot more buyers in the market, and your return on invested capital is slowing as a result. That was really the issue we saw in Q1. And going forward, are people going to stare at the top line? Are they going to stare at the margins? Or are they going to stare at deal flow? But we think net, MEDNAX is a short based on the volume issues. Valuation short interest remain, short interest is up and the multiple is up. So again, looking like a reasonable position to put it on. Not a lot of risk in that short interest and a decent multiple to take advantage of. I'll turn it over to Andrew for ATHNI and Allscripts, and I'll come back on HOLOGIC at the very end here.
Great. So start off with the tracker update through the end of June. Ended up at 28% for Q2, which is down slightly from 31% in the quarter prior. But if we just think about the average year to date, we're still on track for 30% growth. On the next slide, in terms of what we were seeing so far this year, we did flag a slowdown in the beginning of May. You can kind of see the narrative in this chart. We did get a lot of questions on it, so we think that this is a helpful way for people to understand what we were seeing. And so you see the slowdown that coincided with the CFO departure along with the streamline concerns. We did see a snapback towards the end of the quarter, which kind of saved us. Otherwise, we would probably end the quarter somewhere around 25% or below. And then just kind of taking it out after drilling down, you can see the longer term medical practice attrition going back to August of 2014. In terms of doc ads for the quarter, this is our bottom-up analysis. You can see where our contributions are. Fairly healthy contribution from the small and group segment, and then 546 docs in attrition, which is based off of 5% revenue attrition and converting that back to docs for a total number of 2178. Not quite sure where the street's at, but I would imagine it's somewhere close. And in terms of the two key metrics we'll be looking for on the quarter, which they announce earnings after the close on Thursday with the call on Friday, is we're really going to be watching that net promoter score really closely, given the negative impact we saw in Q1 due to streamline. We do expect it to get worse before it gets better. Whether it's 28, 25, 32, whatever, I feel pretty confident that number is going to be lower, but I also think that's pretty well baked into consensus at this point. And then in terms of bookings, the financial score of the balanced scorecard, as usual, that's the main proxy for bookings to see if they hit their target. So that's something we'll be looking at closely as well. And given the announced deal flow, we think that they came in at 95% or higher. Going to valuation, the stock's trading at an 8-year low relative to S&P 500. So the question you have to ask yourself is, for a company that can sustainably grow EBITDA at 4 times the rate of the S&P 500 for the next 3 years, how much lower does that forward multiple go? How much closer does it get to the S&P 500 rate, given that growth differential? And so we would argue that all the risks associated with the name currently is fairly priced in at this level, and that things just need to get a little bit better in order to get that stock higher. So we like the setup heading to the back half of the year, and we think that a lot of the downside risks are fairly reflected in the stock. You can see the EV to sales ratio. We'll skip over that. On short interest, this is a minor negative. Short interest has come down, something we flagged before. This time last year we were looking at kind of a ball underwater, which we called out. Given the forward correlation to the excess return, short interest peaked out at 32%. It's now down to 21%. So kind of less fuel there, so to speak. Moving on to all scripts, it's really all about the bookings. So we said it 3 times. We still call out that this is the first quarter in a very long time where there were no press release deals or contract renewal announcements. Now, whether that's because the market's slow, which is what we think it is, or because management's playing games and maybe they're changing their philosophy with respect to announcing new deals, that could very well be the case. But we would put our money on, we are betting on that the market's slow and that it's going to be a poor bookings quarter despite speculation of a big deal pending given the warrant issuance earlier this month. On the next slide, you can see where we are, our bookings growth relative to consensus. Obviously, in the back half, we're forecasting mid-teens down in third quarter and fourth quarter relative to consensus, which is forecasting flat growth. Last quarter, we kind of saw our thesis start to play out with software delivery bookings, the slowest it's been since the second quarter of 2013, with really the only thing holding the aggregate growth rate up was the cross-sell for client services, which is positive, but at the same time, it's non-profitable growth. You can see this on the next slide where it shows the gross margin expansion over last year due to those cost-cutting initiatives, but we're starting to see the rate of change slow and go negative as the mix shift really does favor low-margin services business. On the multiple, we're still at the low end of the historical range, but we do think that can go lower. We think that the stock should trade somewhere in the 6 to 8 times EV to EBITDA range, just given our assessment of the market and the margin profile of the business going forward. We think that EPS growth is going to be relatively muted, especially relative to consensus over the next 3 to 5 years. And then on short interest, still much lower than it peaked out in 08-09, which is probably not a relative period or a good comparison period, but it's the highest it's been since 2010. So, again, either people are following us into the trade or they see what we see as well. And then I'll hand it back to Tom to talk logic.
Yeah, so on the Tomo cliff, something we highlighted in our deck of a couple months ago, we think June is going to be really the peak quarter. I think we've gotten a lot of data and evidence to support that. Breast health sales growth essentially coming in lower, although sell side has brought their numbers down since the fiscal 2Q, but I still think there's a lot more slowdown coming into 17. Which is going to affect, on the breast health side, affect the total company growth, which is, if we get to 0% total top line, I don't care what's in the pipeline or how robust a communicator Steve McMillan is, I think it's going to be a problem for the multiple where we're trading at sort of 12 times EV to EBITDA. This belongs and historically is traded for that growth rate somewhere in the high single digits. And also the key call out too is that 3D Tomo has been a massive accelerator for the gross margin. And where the sell side is going is up and to the right from here, despite the slowdown that we see coming and the declines that we see coming in terms of that relative contribution. That's a key differentiator too in terms of how we modeled it. The multiple has come off its all-time peaks, but it remains very elevated, and the short interest is pretty muted, although the conversations I'm having with clients and subscribers is much more interested in the short side here relative to where they were interested or not interested in the long side when we were pitching it back in 14 and most of 15. And that's it. Let's hit on questions if there are any.
Okay, great. And again, if you have any questions, please submit them on the QA box on the website. I'll get right into it. Do you think maternity will stay low? And is this a new trend for millennials?
I don't know. I mean, it definitely looks that way. It's coincident. So when you look at the demographic of who has kids, it's pretty obvious that it's a demographic between the ages of 25 and 34 by and large, at least particularly the ones that matter, that are more economically sensitive, which is the older cohorts, sort of above the age of 27, are generally commercially insured, employed, and they're clearly, those numbers are falling. And we see a lot of evidence in that where we had the tracker data and then got the full year 2015 numbers, we were off by a couple of thousand on a base of millions. So I think the data is very good, and it'll affect hospital admissions. It'll affect a lot. It's a big piece of the healthcare puzzle, is to figure out what's going on in maternity. Are millennials treating, having kids differently? I'd love to talk to Neil about that. I think he probably has a view. I think there's some birth rate changes with Hispanics, which are a big part of the maternity trend overall, typically in prior years having more kids per capita than other ethnic groups. But our millennials, it seems like it. But what else do they buy? They buy a house. Housing's been relatively weak. They buy a lot of used cars and liquor and watches. So all those things, when we check them in the PCE data, all look very coincident.
Okay, great. Have you seen any attrition related to streamlining the tracker for ATHNI? No, we have not. We've been on the lookout for it. That being said, it's still too early. ATHNI has a 90-day cancellation policy, and then if you assume that there's another 90 to 120-day cycle between choosing to leave ATHNI, selecting a new vendor, and then going live on the new system, we probably would not see any attrition until September at the earliest. So we're looking for it. We haven't seen anything yet, and if we do see something, we'll let you know. If you are still expecting negative same-store admission trends into the back half of 16, then why is HCA not a short here?
It's been right to wait, since we identified this idea. The stock got absolutely pummeled to the low 60s. It sort of recovered to, I think it got over 80, and it's now sort of in the mid to high 70s routinely. Proximity to the catalyst, and we're definitely getting a better visibility into that trend into the back half. It's just a question of timing and perfection of the catalyst and where the sell side is. So personally, I'm going to wait for one more quarter, update the model, which has been very good to me in terms of having a good insight and good forecasting ability into the numbers. So we'll wait for it. I mean, maternity's a big part of it. Although it's a lower price point, lower margin, it is incremental margin. Ortho's okay to good, so that's incrementally positive. That's a huge piece. 17% of inpatient revenue comes from ortho, very high margin. Cardio is the same deal. So I'd like to see a little bit more data points on the slowdown, and then we're looking at acquiring a new data set around real-time hospital admissions, which I hope works out.
Yeah, that'd be great.
Yeah.
Great. I thought Adventist wasn't going live until Q3, but you are assuming 300 doc ads in Q2. And then maybe Josie, you can pull up that slide on ATHNI for the doc ads. So we did confirm, we picked up in our tracker a handful of Adventist regions that are going live on ATHNI this quarter. We cold called each facility, talked to the administrative office, and net it's about 300 docs. We also had Twitter's great. We follow all the EHR companies' Twitter handles and tickers, et cetera. And we came across one of the third-party consultants who are helping Adventist go live with ATHNI, and they happened to tweet that a third of Adventist is going live in June, and 2/3 going live in July and August, which is consistent with what we heard. So.
Okay.
That's how we're getting to the 300 docs in this quarter for Q2. All right. Should we assume that the lack of Illumina pre-announcement is a positive sign, and then the opposite true for HCA?
Are we past? I don't know I can't remember if we're past the date for HCA's typical pre-announcement for the quarter.
I think we are.
Probably, we're the 18th, 19th here. So I would say, I don't know what to say about HCA. They both pre-announce positive and negative, so maybe they have nothing to say. I guess I've been less focused on that name. And on Illumina, they're typically pretty good about, owning up to a miss when time comes. They don't generally pre-announce positive. So I guess the lack of an announcement means that their guidance is intact to a large extent, unless they're going to comment about the back half, which I don't think they will. We have the Illumina HDM file, which has all our data series and the correlations and the crosstabs. So if you want to take a look at that, please email us. But for all I can tell, I mean, my last look at the numbers, I was about $6 million above on the quarter for product revenue. So I think that's a reasonable band to think about upside. And in particular into the back half, I think is where people have a lot of questions. So I think the risk is less around 2Q and much more about what do they say about the back half. Third quarter and fourth quarter certainly anticipate a reasonable ramp that looks very suspicious given that they've really puked out the equipment numbers.
Yeah, okay, great. Given the spike in short interest in AHS, clearly you are not alone. What signal do you look for to know that you're not getting involved too early?
I mean, let's see. So if you look, how do you know? So tracker data comes every week. The sheet is getting really massive and takes several hours to update. Actually hit go Sunday nights and let it run overnight after maybe an hour's worth of work to get it organized and then have an output sheet, and have gotten a lot better about what, understanding what the data means and how it influences our forecast. Again, that's the question: are we early? And I think highlighting the issue in the middle of last year, was not early. I think that was exactly the right time. I think the stock definitely anticipated a lot worse outcome when it hit a low of like 22 in the fall of last year when everything looked like it was falling apart. That was obviously premature and maybe a dumb mistake on our part by sticking around. It didn't look like the short interest has moved all that much around that price volatility. So as we head into this 2Q print, I think what matters obviously for the stock is always what do they say about the next quarter. They have a tremendous amount of visibility. So in as much as they guide it to down sequential revenue, in as much as our tracker points to about 7,300 FTEs in the nurse staffing business, again down sequentially, and the tracker also points to down sequentially again in third quarter, I think that's the play. I mean, I'm building my confidence level at this point, the more work I do on it, that now is the time. $44 anticipates about a 1.1 on EV to sales based on consensus, and that's where it needs to be. That seems like the higher end of the range, and the argument's really going to be about, okay, I've got the 60% margin business in other workforce solutions. Is that really my value driver going forward? I would counter and say that other workforce solutions is really an addendum to the core staffing business, so that once the staffing starts to slow, other workforce solutions will follow. Also, that 8%, 9% pricing on an FTE basis is unsustainable if volume's down. They're both tied at the hip. So if volume's down, pricing is going to slow to go negative. It all depends on degrees of variability. But at $44, I feel much more confident based on the work I've done for the last weeks, and particularly focusing on the last couple of days.
Okay, great. Why would Hologic's multiple realistically compress to sub 10 on an EV to EBITDA basis? Nothing over $3 billion in cap in medtech is trading at those levels. Even slow growth, boring companies like HRC.
I would counter and say that equipment and supplies on a relative and absolute multiple basis is extended. The Z-score relative to where it's been to itself and relative to the S&P is multiple standard deviations above where it has been. So there's been a real healthy appetite for medtech. Whether or not that's justified, whether or not people are last data point carry forward on growth from the Affordable Care Act, from a resumption in growth in the medical economy, that's all to be argued. I would say that Hologic, and every company, frankly, has its own multiple based on the quality of its businesses, based on the visibility that investors get either through the sell side or through management. And Hologic ultimately is a very high quality business with limited visibility. It's not like PAP is going to get cut. It has been cut, but it's a very high incremental gross margin business. Skeletal health, I don't know squat about skeletal health. I mean, it's a tiny stubby business that happens to grow X amount very routinely. The surgical business, I would say, OBGYN surgical business has been a mix shift change. It's really not hard to model, but again, it's a small piece. But the real visibility change here is I think you've got a massive delta between what management is saying about 3D growth. They're not necessarily, we had to back into the gross margin impact. But going forward, yeah, if you're going to be sitting there telling me that I'm going to pay 12 times for the key product in decline, for total top line of 0, falling gross margins and falling operating margins, Godspeed to you. I will take the other side of that bet all day long.
And missing expectations.
And missing expectations. So let's just roll back the clock and say, well, what did people say? This is the simple argument. What did people pay for this thing when growth was 0 and there were problems and there was issues with visibility? I would say definitively that the new management team is much, much better than the old management team. In fact, a lot of people seem to cheer privately when Glenn Muir left. But because he blew me up a couple of times, just getting bad information. But net, yeah, keep it simple. What do you pay for 0% growth?
Yeah,
I think you pay 8 times.
The correlation to breast health sales growth, product sales growth, and the forward multiples
everybody.
is
I'm
pretty
telling
high.
you, everybody's keying off of breast health and the upside. If breast health, misses expectations and actually starts to disappoint, I think a lot of the goodwill that Steve McMillan has been has built up, and that he's cashing in at this point.
Yeah.
And really, really countering what we've been saying by, there's a long runway. It's more like a plateau. That's at risk. So it's reputational on both sides.
Okay. And then can you comment on non-approval meltdown in HMOs here? Any impact on UNH?
Well, obviously, no. I mean, they're not engaged in any M&A right now. I would say on the margin, probably, I don't know if it would be a positive or negative. I mean, I would assume, I don't know.
Okay. All right, great. All right, well, that's all the questions we have today. Thanks, Tom, and thanks, everyone, for joining us, and catch you back here next time.